Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. In this video, I'm going to talk about how US Fed rate hikes will affect your stock portfolio. I will talk about why it's important not to time the market and what is my investing strategy going forward to go through this large bear market. If you like this video, make sure to hit the like button, subscribe and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With their support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Take a look. Let's start. As an investor, the first question you may ask is how US Fed rate hikes will affect your stock portfolio going forward. Before I answer this question, I'll give you some context first. The US Fed had very easy monetary policies in the past 14 years since the 2008 world financial crisis. For example, if you look at this here, you can see the US Fed had expanded its balance sheet made up of US Treasuries and mortgage-backed securities from $905 billion in September 2008 to $8.9 trillion in June 2022. This means the US Fed had injected more than $8 trillion of liquidity and money into the US economy during this period. During the same period, if you look at this here, you can see the US Fed had decreased its federal funds rate significantly from 5% to near 0% during the 2008 world financial crisis. When the pandemic started in 2020, the US Fed had also decreased its federal funds rate significantly from 1.55% to near 0% in order to help the US economy recover. At the time of making this video, the US inflation rate is at a 40-year high. The US Fed recently increased its federal funds rate by 75 bips, which makes the federal funds rate between 1.5% and 1.75%. Here's the important part you want to know, so you will know how the US Fed's rate hikes will affect your stock portfolio going forward. During the same period I just talked about when the US Fed had very easy monetary policies, you can see the S&P 500 index increased as much as 186%, and the Nasdaq index increased as much as 350%. Also, the US housing price index increased a lot during the same period. Now, the US Fed is tightening its monetary policies, increasing interest rates aggressively to tame inflation, and reducing its balance sheet by letting its US Treasuries and mortgage-backed securities mature instead of reinvesting them every month. For example, at the time of making this video, the US CPI inflation has reached another 40-year record high at 8.6% in May of 2022. This is the highest since 1981. The US Fed's much preferred PCE inflation rate was at 6.3% in April of 2022. This is much higher than the US Fed's 2% target inflation rate. In response to the highest inflation since 1981, the US Fed is raising its interest rates aggressively to tame inflation. For example, the US Fed recently increased its interest rate by 75 bips, which puts the federal funds rate between 1.5% and 1.75% at the time of making this video. The US Fed is expected to increase its interest rates aggressively in each meeting going forward until the US inflation is back to the 2% target inflation rate. Because of the US Fed's aggressive rate hikes and the high inflation rate in the US, many economists and companies expect that the US will likely head to a recession and have a hard landing over the next 12 months. This is why many companies have started freezing their hiring and have given much lower revenue guidance for the upcoming quarters. This is also why we're in a large bear market. The high inflation in the US and the US Fed's aggressive monetary policy tightening have essentially crashed the entire US stock market. For example, at the time of making this video, the S&P 500 has dropped 23% from its most recent peak, and the Nasdaq has dropped much more at 33% from the most recent peak. This is from the Wall Street Journal. The central banks, who have been our friends for a very long time, are telling us we should expect pain. That inflation number is the only thing that matters right now. Even if we see growth slowing a lot, that will not be enough to cause the Fed to change course. The reality is that, like stock, with crypto, everyone is a genius in a bull market, said Mark Cuban. Now that prices are falling for both, those companies that were unnaturally sustained by easy money will go away. The irony of it all is the easy money conditions since the 2008 crisis have lent themselves to the greatest period of risk-taking we have ever seen. Mr. Kruger said, Based on what I learned over the years, the US Fed's monetary policies always have the biggest impact on stock prices, housing prices, and even crypto prices. When the US Fed is lowering interest rates and expanding its balance sheet by buying US treasuries and mortgage-backed securities every month, it helps the US economy recover quickly. It increases the money supply in the market, lowers borrowing costs for both consumers and businesses, increases consumer spending, increases business spending, hiring, and investments, decreases the unemployment rate, and ultimately increases stock prices, housing prices, and even many crypto prices. But the biggest risk of easy money monetary policies is injecting too much money into the economy and therefore increasing inflation substantially. But when the US Fed is raising interest rates aggressively and reducing its balance sheet every month, it slows down economic growth. It increases borrowing costs for consumers and businesses, decreases consumer spending, decreases business spending, hiring and investments, increases the unemployment rates, and ultimately decreases stock prices, housing prices, and also crypto prices. The biggest risk of monetary policy tightening is raising interest rates too much, therefore causing the US economy to head into a recession and increasing the unemployment rate. In the short term, it will take the US Fed a while to bring the US inflation back to the 2% target inflation rate. The US Fed will continue raising interest rates aggressively until the US inflation is back to the 2% target inflation rate. This means we can expect there will be more market sell-offs if the US inflation continues to reach new record highs in the upcoming months, and if the US inflation is not slowing down yet. In my opinion, I don't think we're near the bottom yet because there are still many external factors that are affecting the US inflation rate. All these external factors are outside of the US Fed's control. For example, these external factors include the ongoing Ukraine war, high energy prices, high commodity prices, high food prices, supply chain issues around the world, chip shortage, COVID-19 lockdowns in China, and labor shortage. In the long run, I believe the US inflation will eventually drop back to the 2% target inflation rate because the US Fed is raising its interest rates aggressively and reducing its balance sheet every month. In my opinion, I expect the S&P 500 and Nasdaq will start recovering when the US inflation peaks and when the US Fed starts slowing its interest rate hikes. According to this article here, over 15 bear markets since 1950s, the average downturn is a loss of 30%, lasting just under a year to reach the bottom and taking a little more than 1.5 years to break even. So why is it important not to time the market? In my opinion, I believe it's impossible to predict the market and predict when the market will bottom. For example, not many people predicted the Ukraine war and how it has impacted oil prices and inflation around the world. Based on my experience investing for more than 12 years, I believe one of the most common investment mistakes is trying to time the market and trying to predict the market bottom. In this bear market, many investors are concerned that their stock portfolios will drop further because of the US Fed's aggressive interest rate hikes and high inflation around the world. Many investors want to sell to cut their losses, buy back their stocks at lower prices, and invest again when it's a bull market. But the biggest problem is this: no one can really predict when the market will bottom. You can guess when the market will bottom and start recovering, but it's very hard to predict what the market will do the next day, next week, next month, or next year. At the time of making this video, the S&P 500 has dropped 23% from its most recent peak. The Nasdaq has dropped 33% from the most recent peak. If you bought many hyper-growth stocks that are in the ARK ETFs, you will know that most of these hyper-growth stocks are down more than 50% from their most recent peaks. For example, the ARK Innovation ETF is down 75% from the most recent peak. Based on all the bear markets since 1950, the S&P 500 had dropped an average of 30% from peak to trough. The S&P 500 took an average of 603 days or slightly over 1.5 years to break even. If you can predict the market bottom and time the market well, then it makes sense to sell your stocks now and buy them back when prices are lower. However, I believe it's almost impossible to predict the market bottom. In my opinion, no one really knows what the market will do tomorrow, next week, next month, or next year. The market can be very irrational in the short term because the market is always driven by investors' emotions known as fear and greed. However, in the long term, the US stock market is much more rational. Stocks are driven primarily by company earnings and fundamentals in the long run. Warren Buffett's mentor Benjamin Graham said this: "In the short run, the market is a voting machine, but in the long run, it's a weighing machine. The biggest risk of timing the market is trying to predict the bottom and missing out on the bull market when it returns. For example, many investors want to sell to cut their losses in a bear market. Then they want to start buying stocks again when it's a bull market. but the problem is that stock prices in general tend to go up very quickly when it's a bull market. But the time is clearly a bull market, most stocks will be traded at a premium or they are already overvalued. This means the best time to invest is when we're in a large bear market because most stocks and ETFs will be traded at a discount or they're undervalued. If you look at the S&P 500's past 30 years annual returns here, you can see it's down 23% year to date. The worst bear markets was the 2008 financial crisis. Between the peak in October 2007 and the trough in March 2009, the S&P 500 had dropped as much as 56%. In the past 30 years, you can see bull markets lasting much longer than bear markets. If you wait until it's clearly a bull market, you will have a much bigger chance of buying stocks that are overvalued. Also, if you invested in the S&P 500 ETF in the past 30 years, your portfolio will still perform very well even after the year 2000 dot-com bubble, the 2008 world financial crisis, and the 2020 pandemic. In my opinion, instead of timing the market and trying to predict the market bottom, I believe one of the best investing approach is to continue buying the S&P 500 index every month. Buy more shares when the S&P 500 is in a large bear market and invest for the long term. More than 90% of the actively managed funds actually underperform the S&P 500 substantially over the long run. Even Warren Buffett suggests investing in the S&P 500 index over the long run. So what is my investing strategy going forward to go through this bear market? Personally, I like to pick my own stocks instead of investing in ETFs. However, if I don't have the time to research my own stocks, I will just keep buying the S&P 500 and Nasdaq 100 ETFs over time and keep buying more shares when it's a bear market. So here's my investing strategy. My strategy is to keep investing in the best businesses when they become undervalued and invest in them for the long term so their businesses can grow exponentially or in value over time. I will give you several examples here. Personally, I have several investment accounts. I use the same investing strategy in all the accounts. Last year in September 2021, right before the current bear market, I predicted that there would be three major catalysts that would cause the US stock market to head into a correction. I said the three major catalysts were the US Fed tapering, high inflation rate in the US, and high stock valuations. At the time, this gold stock portfolio was at 620,000. Now this gold stock portfolio is at 423,000. During this period, the Nasdaq has dropped 33% from the most recent peak. When the market recovers and when it's a bull market again, I expect this portfolio will grow substantially going forward. Now, I did make many mistakes in this portfolio here. For example, I bought too many hyper-growth stocks in 2021, such as Shopify, Block, Roblox, C-Limited, Copan, and Coinbase. You can see these stocks have dropped substantially because the US Fed started tightening its monetary policies and raising its interest rates aggressively. There are no more easy money monetary policies to support these hyper-growth stocks. In hindsight, if I can choose again, I would not invest in these hyper-growth stocks because I realized they were substantially overvalued when I bought them. More importantly, these companies do not have large economic moats, strong fundamentals, and increasing earnings over time. Going forward, my investing strategy is to invest in the best businesses that have strong fundamentals, large economic moats, increasing earnings, and increasing free cash flows over time. For example, I will invest in more Apple, Alphabet, Microsoft, and Tesla going forward when they become undervalued because I believe they have very strong fundamentals, large economic moats, increasing earnings, and increasing free cash flows over time. In this high inflation market, only the best companies with strong fundamentals and large economic moats can survive and grow their businesses. Companies with very weak fundamentals, no economic moats, and negative earnings will need to downsize because interest rates are much higher and because the US economy will likely head into a recession over the next 12 months. Here's another example. This account has done very well even in this bear market because I invested mainly in the best companies that have strong fundamentals, large economic moats, increasing earnings, and increasing free cash flows over time. Also, I bought them when their prices were much lower. If you look at this here, you can see some of the best companies including Apple, Amazon, Google, MasterCard, Microsoft, Tesla, and Visa. You'll notice that I did not invest in many hyper-growth stocks in this account. Instead, I mainly focus on the best companies with large economic moats and increasing earnings over time. I bought them when the prices were much lower. This is why this account has done very well even in this bear market. In my opinion, the bull market will eventually return. This bear market will likely last for at least several quarters to 2 years until the US inflation starts slowing down and until the US Fed starts slowing its interest rate hikes. In in the long run, the US inflation will eventually return to a 2% target inflation rate because of the US Fed's interest rate hikes. Buffett wrote this in his 2020 shareholder letter. I believe it's very relevant in this bear market. Today, many people forge similar miracles throughout the world, creating a spread of prosperity that benefits all of humanity. In its brief 2032 years of existence, however, there has been no incubator for unleashing human potential like America. Despite some severe interruptions, our country's economic progress has been breathtaking. Beyond that, we retain our constitutional aspiration of becoming a more perfect union. Progress on that front has been slow, uneven, and often discouraging. We have, however, moved forward and will continue to do so. Then Buffett concluded, our unwavering conclusion, never bet against America. Same as Buffett's thinking, I will never bet against America's long-term economic growth. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. It's important to always invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting the channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.